calling in from New York City. Welcome to the Diamond Standard Seminar. We have some exciting things to talk about today. Number one, we're going to unveil our new spot marketplace. This is where you can trade the Diamond Standard coins and bars. If you're not familiar, and we have about 200 people joining today's webinar, these are Diamond Standard coins, and the diamonds are inside, and these are the world's first and only regulator-approved diamond commodities. What that means is, for the first time, investors can invest in diamond. They can allocate to this new hard asset class that was always just out of reach. Because as a commodity, these coins all have the exact same value. They have the same geology in every coin. This is very exciting because there's not very often that a new commodity becomes available. And fortunately for us and for all of our investors, this commodity has done tremendously well since this. This was when Diamond Standard was first unveiled in the Wall Street Journal. Since this article, our commodity has gone up 33%. It's gone up to outperform gold, silver by more than 40%. It's outperformed even the S&P 500 by nearly 20%. So this is not unusual when you have a new asset class that's becoming financialized for the very first time. That demand from investors has an impact on the market price. We're going to have a short agenda. We're not going to drag too much. I want to show you our new site that we've launched. So let me share a couple of windows here. Just share it in two different apps. One moment. So the first screen that you'll see is this is the Diamond Standard website, diamondstandard.co. And you'll see on this site, really what I want to show you is, first of all, this is the current price of Diamond Standard coins. This is the offering price. We don't set this price. This price is the result of a regulated index called the Diamond Standard Index. You can look it up on Bloomberg. I see there's a Bloomberg right behind me, which has the Diamond Standard Index chart on it, showing it outperforming gold, silver, and the S&P. But what's important is you can see that that's the price that Diamond Standard sells new coins at. And as I mentioned, that price has appreciated by over 30% since the initial offering. And that's a very, very positive result. And part of it is because jewelry demand during COVID was strong. Part of it is because the supply of diamonds has been diminishing. Part of it is the demand from our commodity buyers. But the number one question that we always get from investors, and we've gotten this for a year, is, great, I love to buy this commodity. I'm a long-term investor, but when I want to, how do I sell this commodity? And we thought the answer would be we would list the token that's inside the coin and bar on platforms like Coinbase, and we're still working on that. But we thought that the best step would be to first create a marketplace between all of our clients. One thing I forgot to mention in the coin, if you look at the side and you can see it from the back, that white layer inside a Diamond Standard coin is actually a wireless computer chip. And that chip has a very important function, which is it stores a blockchain token. And while these coins are sitting in an authorized custodian like Brinks, you and I can trade that token. Diamond Standard has the world's only regulatory license for a commodity token. What that means is whoever owns that token owns the commodity. They can take delivery of the physical coin whenever they want by contacting the trust that administers the custody of Brinks. But so that brings us to the exchange. This exchange has not been announced to the public yet, and this is the spot marketplace where anybody can trade, whoops, Diamond Standard coins. Not sure I'm sharing that. Okay. Sorry, I think I stopped sharing. Okay. So this is the Diamond Standard marketplace. I think for some people, they didn't see the website. So what I want to point out here is if you go to Diamond Standard and buy a coin, it's $59.10. In this spot marketplace, we're actually trading the tokens that are inside the coins. And again, whoever owns the token, they own the coin. So I've connected a wallet to this. The coins are in my wallet, in my case. I own the coin, I own the token. The token's in my wallet. I've connected my digital wallet to this exchange. I did not deposit my coins in this exchange. I'm self-custodying, but the exchange is displaying what's in my wallet. And what you see in my wallet is one coin that has a current market price of $59.10. That's the spot. Below that, you'll see the bids and the asks. This marketplace is what's called a centralized limit order book, meaning that whoever wants to trade here, they enter a bid or an ask, which is a limit with a limit price, and the exchange puts those in order. That the best bid and the best ask, they go to the top. And when somebody comes to the exchange and says, I want to buy or I want to sell, they can either take the best bid or they can create their own ask. In this case, we see something that we hoped we would see. We weren't sure we would, but we see a good depth of bids. There are a lot of people who would like to buy Diamond Standard coins. Most of them want to buy it at a discount to what the new coins are available for, the price of the new coins on the market. But this is a very positive sign. The best bid on the market is the actual spot price. Why would someone pay the spot price on the exchange rather than buying a new coin from Diamond Standard? Well, if you buy a new coin from Diamond Standard, it takes us a month to deliver that coin to you. You can't trade your coin for 1 month because we take your money under regulatory supervision and we go and we buy the diamonds. We buy about 10,000 diamonds a week to produce all the coins that the clients bought the previous week. When you buy a token, a BCC token through the exchange, you're buying a coin that's already been delivered to Brinks. You own it instantly, and therefore you can sell it also instantly. You can transact it 5 seconds after you buy it. If you buy a new coin, you are restricted from any transactions for at least a month. Sometimes it's longer depending on our production backlog. On the ask side, we don't see many asks, and that's, we talk to our clients. Very few of our clients want to sell. They all believe in the long-term investment thesis, which is as more investors like funds and futures contracts are accessible to investors, that drives up the market price. Down below, you also see all the trades. All of this is public, by the way, and the address is spot.diamondstandard.co. So everyone in the world, without logging in, can see every transaction that takes place on this exchange. It's utterly transparent. And we see that there's been some amount of trading every day. And what you'll notice, and what I'm most proud of, is those trades have all been very close or even above the spot price. This is very important if you're an investor, potential investor in the Diamond Standard coins, because the question you ask yourself is, great, I can buy this, but can I sell it? Can I sell it at a profit? Can I sell it at the price I paid? Or just does liquidity exist? And the answer, as you can see here, is a resounding yes. Dozens of people have been able to sell their coins at or above the spot price. Everyone who bought these coins, I imagine, has realized 20% return, and perhaps they needed shoes for their baby, so that was a good reason to sell. This exchange is completely blockchain based. That has a couple of benefits. Number one, there's no middlemen. When you are trading on this exchange, you're actually buying a token from someone like me, not me, Diamond Standard, but an individual who owns a coin, who owns a token for a coin that's sitting at Brinks. So uh, that's a direct transaction between two peers. This is what's called a peer-to-peer marketplace. There's no middlemen. There's no brokers or traders. And also because it's very efficient on the blockchain, there's no fees. You have to, perhaps pay Coinbase to move your USDC to the exchange, but there's no fees in the marketplace. It is USDC based, which you'll see here. I don't have any USDC in this account at the moment, but we use USDC on Ethereum. So to fund your account in the marketplace, you go to something like Coinbase. It says you want to deposit funds. You have a private address. That address is your personal address, but we're funding it. So we have access to it through the marketplace. And you send USDC to your wallet in the marketplace, and then that will fund your holdings, and you can buy coins and bars. You could also be a market maker on this venue if you choose to be. A lot of our early clients are professional traders and hedge funds. There's no fees, so you could easily make a spread. You could have a bid and an ask, and potentially take advantage of spikes in demand, and make a market. And because there's no fees, there's really no cost to create friction. Now, so here I am. I have one coin, and I want to sell it. So if I click on the sell button and click on price, it'll tell me this is the best bid at the moment on the marketplace. If I don't like that best bid, I could always submit an ask. I could say I want 59.50, and I want my order to be good for 3 days. It's kill or fill in trader parlance. So if I click submit ask, my 59.50 ask will actually become the best ask on the marketplace, because I can see the best ask at the moment is 59.90. But in this case, I need shoes for my baby. So I'm going to price it, and I'm going to take the best bid. I have to enter a PIN number, and you'll see this will take a moment, but this transaction is all being recorded on the blockchain. This is a public, not public, people don't know it's me, but boom, now I've sold my Diamond Standard coin, and I have $5,910 of USDC. If I choose to, I can withdraw that USDC to any Ethereum address in the world. We do test it. We send a small amount before you withdraw it in case it's not a good Ethereum address, in which case you risk $5 if you put in a bad address, but you don't risk your whole proceeds. We built the safety. So that's how the exchange works. We're extremely proud of the liquidity that our investors have found here, because it really proves the entire Diamond Standard concept. Our concept is we could create a fungible spot commodity, and by creating these so that they're all the same under regulatory supervision, that would instigate price discovery and liquidity with very low friction. Those are the ingredients you need for a successful asset, especially for institutional investors. They need a lot of depth of liquidity, but that's the first test. And think about it. If you buy a diamond on 47th Street and try to sell it on the same day on the same street, I guarantee you lose 30, 40% on that transaction. Even if you have a rare blue diamond and try to sell it at Sotheby's, you have to pay the auction fees, which are about 20%. So we think that we've reduced the friction in trading diamonds from, an average of 30% down to a 0.5%, 1%, which is what our clients have experienced. So this is a very, very positive new um, development for Diamond Standard. So I know a lot of you came to see that. For everyone else, I'm going to continue and I'm going to walk through a little bit of the investment thesis. We've updated all of our charts, all of our the demand and supply that we've seen. And at the very end, I'm going to walk through how do we make the Diamond Standard commodities, which is our number one question that people ask us. So let me switch to a different window that I'm going to share. And this will be our deck. This deck is available if you're logged in through the Zoho seminar. You can download it from the library of materials. Otherwise, please email hello@diamondstandard.co and we'll be happy to send you this deck. So the investment thesis for diamonds is actually quite simple, from an economics perspective, which is if you look at every precious metal, gold, silver, platinum, palladium, etc., rhodium, investors hold at least 15% of the above ground supply of each of those metals. I've never seen a palladium bar, but 15% of all the world's palladium is sitting in a vault owned by an investor, like an ETF or a family office or a sovereign wealth fund. In the case of diamonds, that number we think is somewhere between 1 to 2%. There's a lot of people that own jewelry, but very few, certainly no funds, BlackRocks, PIMCOs, JP Morgans of the world, they don't own a single diamond because they could never mark to market their holdings. There's no price discovery and no liquidity if they wanted to sell their positions in diamonds. We think that's what Diamond Standard has solved. And we expect that diamonds will, perhaps it takes 10 years, maybe 5 years. We think diamonds will catch up with palladium in that 15% of all the world's diamonds will become acquired through a commodity by investors. We're accelerating that process. We're helping that process by doing what we're doing, which is we've launched 2 spot commodities, the Diamond Standard coin and bar. If you haven't seen a bar, that's what they look like. They're larger diamonds. And we've launched now a spot market for these coins and bars, which has been very, very efficient. We've also launched a Diamond Standard fund that's for the large majority of investors that actually don't want to hold commodities. Traders don't mind holding the commodities, but most retirees, et cetera, they just would rather hold a share and let us take care of the custody and the administration and the auditing. And that also makes diamond commodities accessible to IRA accounts, which generally cannot hold diamonds because they're collectibles. We already have approval to list futures, which will be traded on the CME Globex through the MGEX exchange, which is one of our partners. And we're also launching options on the MIAX exchange. We have approval for both of these. That's CFTC licensee approval for futures and options. That opens up a whole new category of investors, including most institutional investors who allocate to precious metals will either do that through a futures contract or through a fund. Long term, we have a big inflection point that we're looking at, which we think will trigger a very substantial cascade of demand that will have an impact on price, which is that diamonds will be added to commodity indices for the very first time. Indices like S&P, Goldman Sachs, and Bloomberg, those are an index of all the commodities that a sovereign wealth fund, a pension, or an endowment, if they allocate to commodities, and very often they allocate 5 to 7%, which is it's more lately, what they're really allocating to is the index. So once diamonds get added to those commodity indices, suddenly overnight you have a whole long list of trillions of dollars of institutional asset managers that will add diamonds to those holdings because they're in the index. So long term, we think that that will cause diamonds to catch up with gold in price appreciation. If you look at gold over the last 20 years, and that's when we think gold was fully financialized, and that's because the ETFs launched. ETFs today are over $100 billion worth of gold. Since that time, gold has gone up 6x, while diamonds have been essentially flat until recently with the advent of Diamond Standard. Diamonds have gone up quite a bit, but essentially diamonds have been flat. We think as diamonds get financialized, that the diamond price may catch up with gold as the investors of the world buy diamonds. We've already seen that start to take place, as I've mentioned. Diamonds are up 33% since that Wall Street Journal article, and you can see that return as dramatically better than the other major assets. And even in 2022, diamonds are nearly flat. They're actually down about, I think, 1.8%, which is fantastic in this rising inflation, rising rates environment. That's kind of a technical aspect. And another important technical aspect is correlations. Historically, diamonds have had literally almost no correlation to any other assets. So this table shows 20 years of correlation at the top and 2 years of correlation at the bottom, diamonds being the top row. And you'll see the correlations are 0.06 to silver, 0.04 to gold, 0.04 to stocks, the S&P 500. I've never seen another asset in my career. And I think I was a portfolio manager at Tudor and Millennium doing quantitative trading. I've never seen an asset that has 0.0 correlation to almost everything. That's very interesting to an institutional investor because this is a positive return relative to its other positions with no correlation. That means that diamonds increase the Sharpe ratio on practically any portfolio in the world. So for an institutional investor, that's very, very interesting. So the last thing I'll mention about diamonds is, there's a lot of investment thesis in here about demand for diamonds, about forecasts for jewelry demand, about the supply of diamonds, how that's been depleted recently, how the sanctions in Russia are going to affect diamonds, but this is what's most interesting, I think, is that there's been no new diamond mines discovered in over 20 years, and the supply is steadily diminishing. Diamond supply is going down 2 to 4% per year, and recently they've closed all the mines in Australia, for example. They've closed 2 of the recent mines that they discovered in Canada. They didn't yield that much. So that's a long-term pressure as supply goes down, price goes up if demand remains constant. So that's the main thing about the macro environment. Also, inflation is an important part of it. So the last thing I want to mention before we go to questions, if you do have questions, please enter them in the Q&A area, and I'll get to as many as I can. But the last thing I'll mention for a lot of people, their number one question is, after how do I sell it? Their number one question is, how the hell do you make this? What makes this a fungible commodity? And it's really interesting. It's a computer science breakthrough that makes it possible. The foundation is that between the coin and the bar, you can see they're all different size diamonds. We can use 94% of all the varieties of gem quality diamonds, up to a little over 2 carats and down to 0.18 carats. Below that, they're too small to grade. It's not worth it. Above that, they're too big to be consistently priced. But because we can because we can use every type of diamond, we're willing to bid on every type of diamond. And we do that as a market maker. We bid on literally 16 million varieties of diamonds. What I mean by a variety is, as you know, every diamond's different. They have a carat weight, a color, a clarity, fluorescence, shape, cut, all these different factors. We don't care about the combination of factors. Whatever they are, we have a bid. And that bid is automatically adjusted through automated market making. And we expose those bids on our diamond exchange. It's called the Diamond Standard Exchange. And today we have 170 members, which are all the largest diamond companies in the world. Our peak listings have recently passed 1 million diamonds per week are listed on our exchange for us to bid on. So the bidding looks a little bit like this, where we bid for every combination of carat weight, color, and clarity. We expose those bids globally. We have 8 intake offices around the world, in Hong Kong, several in India, Dubai, Antwerp, Israel, New York, Thailand, Bangkok, Thailand. Wherever the diamonds are, we bid, and when we buy the diamonds, we take delivery in those countries. So we provide not only the market making, but also the global settlement and clearing. Our bidding is automated, and we automatically raise these bids depending on the market conditions. And we need to accomplish the same target every week, which is we have to buy a statistically valid sample of all the diamonds in the range. So we have to raise our bids until somebody in the world sells us a little bit of every different type of diamond. The diamonds that we buy, we make public, and we can prove that this week, last week, the week before, or 30 years from now, that we forced price discovery and we bought a statistically equal sample of diamonds. The diamonds are never the same. We buy about 10,000 diamonds a week, sometimes a lot more, as many as 30,000. So the piles might be larger or smaller, but all of the characteristics, things like what's the frequency of F color, the distribution of clarities, the median carat weight of all the flawless diamonds, all of those statistics for every sample are always the same. And that statistical pattern, that is the diamond standard. That's how we make a commodity, is by forcing price discovery and acquiring a statistically valid sample that's always equivalent of every different type of diamond. The last step is we have a pile of diamonds, 10,000 or 30,000, and our optimization system divides those diamonds equally into coins and bars. What you'll always notice, and every coin is public, anybody can look up a coin and see the diamonds in them. They can inspect the gemological certificates. Every diamond is graded by the GIA and the IGI. All the certificates are public. But what you'll notice in every coin is that the diamonds are different, but they're very similar. And they always have a progression of carat weight, color, and clarity. Every diamond itself has a yield curve of diamonds in it: good, better, and best, different colors, clarities, etc. So that's what that transparency and that consistency is what makes every coin equivalent, and that's why they're good for delivery as a commodity on exchanges like the CME. That entire process is supervised and regulated by the Bermuda Monetary Authority and audited by Deloitte. The BMA oversees our offerings of coins and bars and tokens. I should mention they do not oversee the Diamond Standard marketplace. So that's it. That's what I wanted to present. Let's see where we are with questions. Question number 1, where is the vault located? Physical custody. Very good question. We uh, actually built a vault in partnership with Brinks. That vault we had to build because we needed it to be in Delaware. So all of the coins and bars that are traded on the marketplace are in custody at Brinks in Delaware. And the reason it had to be in Delaware is there's no sales tax in Delaware. If we were to sell you a coin and deliver it in your name in New York, even if it's to Brinks, we would have to collect sales tax from all of the owners. So to make it very efficient, we do all of the deliveries to Brinks in Delaware. We have regulatory approval for additional custody locations around the world. So in the future, we will be expanding custody to Europe, to Switzerland, Hong Kong, Singapore, Canada, and I'm sure I missed one. But depending on where you are in the world as an investor, you may need to have your asset in the same country. Certainly, some of the public funds that hold the commodity need it to be in their domicile. To be clear, all the coins and bars in the spot market must be in custody. That's exactly right. If I have this bar in my hand, I can't possibly list the token and sell it because how are you going to get it from me? So actually, if I have the bar in hand, the token is frozen. You can't trade the token because the bar itself, the chip in the commodity, signs the transaction. It confirms that the commodity is good for delivery, that Brinks can provide it to the new buyer. Let me see if there's any other questions. How are you dealing with synthetic diamonds? Will that disrupt the market? Great question. So synthetic diamonds are a good and bad. We will have to see what the impact is. It was good for the launch of Diamond Standard because it created fear in the diamond industry. One thing that we're doing that made the diamond industry very nervous is that we're creating transparency. We created the world's first ever in history electronic exchange for diamonds that has a market maker, has settlement, etc. That's never existed in the history of diamonds. That transparency and the fact that we're regulated meant that all of our members had to go through KYC and AML. That's scary, and it's because of their fear of what will be the impact of synthetic diamonds for the natural diamond vendors that drove them to work with us, and also the labs. Your girlfriend can't tell the difference with a synthetic diamond, but if you ask her to marry you, she's going to want to see the certificate, and I know that from experience. My wife is a famous jewelry designer, but if you give a synthetic diamond to a lab, they can tell instantly that it's synthetic. Synthetic diamonds are grown over a couple months. Natural diamonds are grown over a couple million years. So chemically, they're the same chemistry, but physically, structurally, the crystal lattice wise, natural diamonds are very, very different from synthetic. So we don't use any synthetic. We only use natural. They're all certified and they're inspected by 2 gem labs every diamond. But the question is, what will synthetic diamonds impact be on demand? So far, they've had no demand. Synthetic diamonds have been around for about 5 years, and their value, market price in synthetics, have fallen about 80%. The market price for natural diamonds has risen by 40% in that time. So what we've seen is that synthetic diamonds have created new customers who are generally more fashion, more of a fashion buyer, and they buy the synthetic diamonds the way they'll buy some blue jeans. They'll wear them for a couple seasons and then, just kind of stick them in the closet. When you buy a synthetic diamond at the mall from Zales, for example, their buyback guarantee is void. They will not buy back a synthetic diamond. They will not allow you to trade it in for an upgrade, which they will do with a natural diamond. So we think that diamonds will be similar to sapphires and rubies, and they've had synthetic sapphires and rubies for over 50 years. Both of them are at their all-time high. So we don't think that synthetics will diminish the demand for natural, any more than a look-alike bag will diminish the demand for an Hermes bag. But diamonds, we think that the biggest impact will be this completely new investor demand. That, as I mentioned before, investors buying, we think, what will be 15% of the total supply of diamonds. There's no way you can buy that. That's 12 years worth of production from every diamond mine in the world. There's no way we can buy that volume of diamonds and turn them into commodities without dramatically impacting the price. One way we're doing that, and it's part of our ESG story, is that ultimately we need to buy a lot of our diamonds from consumers. And part of our business is we're launching a recycling company. We're actively right now constructing our first recycling facility here in New York, and we plan to buy back diamonds from consumers, which is a benefit to everyone who owns a diamond anywhere in the world. Do you ever anticipate someone buying a coin and using the diamonds for personal use? Well, we built it with that in mind. If you take a diamond standard bar, and if you go to your hardware store and buy a can of paint thinner, and you soak this overnight or for 2 days, the resin is designed to melt. Paint thinner doesn't do anything to diamonds, but by just putting it in paint thinner, you destroy the chip. Number one, you destroy the commodity, but now you have 8 GIA certified diamonds. You can put them into a bracelet, you can sell them individually, you can distribute them to your grandchildren, whatever it may be. I don't recommend that because of friction. If you were to break apart a diamond standard bar and try to sell the individual diamonds, you now have that friction of trying to find 8 buyers or 1 buyer for all the diamonds who is going to lowball you. And but in reality, right now, the market prices for diamond standard coins are low. If you could not buy yourself, you could not buy these 8 diamonds for the market price of the coin. Because of our efficiency, the way we buy diamonds globally, automatically, provide settlement, there's no retail markup. We don't even set the price of the coins. You're buying this bar for less than the market price of diamonds. That doesn't mean you can sell it and make a profit because who's going to buy them from you? If my coin and bar is tokenized, meaning that it's at Brinks and it's stored in my wallet, what happens if I lose access to my wallet? Can I retrieve my coin and bar? The answer is yes. This is a huge benefit of our token compared to Bitcoin. If you lose your Bitcoin wallet, you're out of luck. If you lose your Diamond Standard wallet, we know who bought from us, and we can, and the blockchain is public for the last transaction. So if you lose your coin, or if there's a court order, or if there's a will where there's a probate where the judge says this kid owns that coin because from their grandfather, then Diamond Standard is able to either we can lock a stolen coin, we can lock a stolen token, or we can recover a token. To recover a token, we actually have to get the bar or coin. We return the coin to the gem lab, and we actually dissolve the diamonds out of the coin, and we re-register those same diamonds in a new coin. We cannot reset your blockchain key, but we can recover your asset. We charge a fee for that of $200. But if you lose your token and it's at Brinks, we can recover the coin asset for you for a fee. How much commission do you charge in a transaction? Exactly 0. The Diamond Standard spot market has no transactions. When you're buying a new coin from us, we don't charge a transaction fee on the coin, but when we buy the diamonds, our exchange charges a 3.5% fee for every diamond that we buy. So in that way, we're a bit like an agency, and that's why we don't really have a dog in the fight of diamond prices going up or down. Our job is to make a consistent commodity every time. Any other questions? Let me see from both I have two windows here. I think that's it. Well, I want to thank everyone for attending this webinar. If you have any questions, please visit our website, diamondstandard.co. If you want a copy of this deck, the Investor Outlook, we have also another Diamond Outlook. Email hello@diamondstandard.co, and we'd be happy to send that to you. And yeah, thank you everyone for attending. Talk to you soon.